Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today what we're going to be talking about is, over the years, we've had many conversations with Nelson when he was with us. And one of the things that he used to always talk about was the seen versus the unseen. And so today, Anthony and I have made a list of six different aspects of infinite banking that we're going to touch on, and the difference between the seen versus the unseen.
I am super excited for this.
I know you are, because you've brought this topic up many times, and I've always shut you down. No, I'm kidding. No, I know you were excited about this one. Yeah.
Well, I think this is important because oftentimes people they're looking at what is seen, like what they can see in the illustration, which is important, but they're not looking outside of the numbers on what is unseen. And so we're going to cover that today.
Awesome. Let's get started on our first topic. The seen is going to be the cash value growth. Mm-hmm. Anthony, can you share some thoughts on what the unseen might be when people look at that cash value column?
Well, a few items here. For one is you have control of your cash value, right? And there's going to be times when you have an opportunity. That could be maybe a negative one, like you need a new roof, or there's some medical bills, or you're laid off, right? And you need some liquidity. And the problem is with most people, they don't have liquidity. They're putting all their money in these 401ks. And the problem is when you need it, you got to pay tax and a penalty on it. Mm-hmm. Okay, so we want to have some strong liquidity, but also there's going to be some great opportunities, particularly in these next couple years. Once a government stops handing out all this free money, like assets are going to be more valued where they should be. There's going to be some corrections, and oftentimes we overreact. Like right now, the stock market is super high, and then when it crashes, we're going to overreact, and more people are going to sell, which means there's going to be an opportunity. Whether that's a stock market, the housing market, or expanding your business, or taking courses or something, there's going to be some opportunities, particularly these next couple of years. But in order to take advantage of it, you have to have liquidity. And one thing I like to say is the larger the opportunity, the smaller the window it is to take advantage of it. So those good opportunities are going to be closed fast. So we need to have that liquidity to jump on it.
So what I heard you say there was really two things. One was control, and then also liquidity. And along with liquidity, what you were talking about is the opportunities that are found outside of the policy.
Exactly, right? And, we are often saying that your policy is not the investment, right? The policy is the safe place to store cash. It earns a good rate of return. You have access to it, and it's protected from creditors, right? But all of that stuff, or all the numbers or the cash value, is going to be in the policy. But what is unseen is what you do with the policy. Right? For example, we want you to, when an opportunity comes, to put the policy to work. And a really easy example is buying a cash flowing asset like real estate. Like if you can leverage against your policy and buy a cash flowing asset, use that cash flow to repay the policy, then now you have a cash flowing asset, and your cash value is still there because we never touched it. We borrowed against it. So that way we have both. We have the cash value growth in your policy, and we have a cash flowing asset. So then I always say when you do that, you hit the repeat button. Or Cameron likes to say, rinse and repeat. Okay, however you want to say it, it's the same meaning, right? So then you buy another house. And now you have the cash flow from property one and the cash flow from property two. You pay back that faster. So what is unseen looking at the numbers is what you do with the policy. And if you're working with us, we're going to push you to put that money to work. And so you should have some assets outside of the policy.
Anthony, I'm glad you mentioned that as far as the opportunities, and those are the part that's unseen. We just wrapped up a video, a live webinar with Sarah Sullivan. And what she did is she went through and she identified 15 different types of real estate opportunities that exist. And so for those of you that, for those of you that would like to watch that, reach out to us, because where that's going to be is that's going to be inside of our course. And so we can have that conversation. If you guys are clients and don't have access yet, we'll give you access. But again, that's a great video to help people see kind of the unseen, see those opportunities that may be out there. Awesome. Let's move on. Topic number 2 is this one. I don't think that you and I, honestly, we don't do this one justice. Ever, right? We very little. We were always focused on cash value and the opportunities, just like we talked about. But number 2 of the unseen versus unseen is going to be the death benefit. Anthony, share some insights in the death benefit here.
Okay, one quick item is if we have permanent death benefit, then maybe we don't need as much term insurance. Mm-hmm. Okay, so we could save some cash flow right there. But also with the death benefit, there's ways that you can use that death benefit while you're still alive. And that's called the accelerated death benefit. And there's a few ways that you can use it. For one, what's been in there for a long time is if you're terminally ill. Mm-hmm. If you're terminally ill, you can get access to your death benefit. And you know, the great story would be is you take that death benefit and then you get some treatment that's not covered by insurance, right? And now you're no longer terminally ill, and you don't need to pay that money back.
Yeah.
Okay. But then what's happening with what a lot of these insurance companies have done lately is, I don't know, hopefully you guys haven't been exposed to it, but the cost of long-term care is getting out of control, right? People are living longer, but a lot of times they're having some cognitive issues. So their quality of life is not going to be as enjoyable, but they're going to need some additional care. And a traditional long-term care policy can be very expensive.
Yeah, it is.
Okay. But what the Congress allowed some of these policies to do is that you can use that death benefit to pay part of your long-term care expenses. Now, it's not a replacement of long-term care because there are some nuances to it as well, but it's a great benefit. Mm-hmm. If you do need it and you don't have the ability to get the care you need, you can use some of that death benefit to help with those costs.
What I'll throw in there is this is what I've noticed over the last several years is as clients age, right, is typically we're always talking about cash value and the accumulation part of it, and that death benefit piece really goes underappreciated. But where I see it kind of make a revival is when people enter retirement, their number one concern is always, hey, I got to make sure that I have enough money, mm-hmm. right? That's the number one concern. And then once we start to satisfy that, what ends up happening is you see this shift of, I know I'm okay, so now what I want to do is I want to make sure I leave a legacy for my kids, mm-hmm. right? And so that's the shift that you see when people know that they're taken care of. And I'll share personal stories. Over the last 3 months, to be honest, is I've been laid up with a bad back, and I haven't really been doing much at all. I've been laying in bed for a really long time, and what's bothered me is watching how my kids have kind of slowly been distracted, and by distracted, been kind of preoccupied with electronics. And so my idea of legacy, that really bothered me. My idea of legacy, what I'm trying to implement now is trying to create this idea of this family kind of mission statement. Right. And so I want to put that in place now today. And so we're all kind of moving towards one kind of common goal with our family. So, right, there's legacy comes into play with that death benefit in a number of different ways.
And also what we're helping out that next generation. Mm-hmm. What a lot of times we'd recommend, I'm a big fan of getting policies on children. Mm-hmm. Like that's where I've had policies on my kids and they've used it to finance their education. And then when they've graduated, I'm like, okay, great. Here's Nelson's book. Here's his policy. Start paying the premiums.
Yep.
Right. But what we're doing is we're teaching them how to use the policy. And what we've done with my daughter, who's a senior in college, we have more cash value in the policy than she needs for her education. So we're putting it to work. Right. She used some of that money to start our land flipping business. Also, next month, her and I will be closing. We're going in halvesies on a rental house. Right. So we're trying to teach her about money, about creating some passive income. And I'm not saying this to toot my own horn, but the other day we had a conversation. I told her, hey, our rental property, we're finally off the waiting list. And she's like, Dad, you know what? Thank you. And I'm like, what for? Because I wanted her to go into detail, right?
Because you wanted more, yeah.
Because, she's a senior, and now she's like, okay, now I'm about to go in the real world, right? And she goes, none of my friends' parents are having talk about money. Nobody talks about passive income, starting a business, or owning a rental property. And now I'm going to graduate, and I have one rental property and a business, right? So we need to teach, because we're going to leave our kids a legacy. Doesn't need to be financial, right? Well, hopefully there is some financial to it, but the most important thing is the knowledge or the sense. We need to be able to teach them how money works. Because if you're a client of ours, you're going to end up having more death benefit than you ever imagined. And we need to make sure that our kids are good stewards of money when they have a little. So when they get a lot, they're going to be able to take advantage of it.
Awesome. Great point.
One more thing about the death benefit, okay? Because if you're doing like a Dave Ramsey or typical financial planning, you're not recommended to have death benefit until once the kids are out of college, okay? But I would tell you, from what I've seen, when one spouse dies first, well, for example, let's talk about your second favorite movie, Cameron. Okay, we know
Dirty Dancing?
No. Okay, well, maybe this is your third. We already know, we've already talked on the podcast that your favorite movie is, what's a Zohan?
Don't mess with the Zohan.
Yeah, Don't Mess with the Zohan, right? If you haven't seen it, check it out, okay? And then his second favorite movie, or third, I'm not sure where Dirty Dancing and The Notebook comes into play, okay? But if you haven't seen it, I'm giving you a spoiler, but it's been out for over 10 years, okay? But if you haven't seen it, you want to score some points with the wife? Say, hey, let's watch The Notebook together, okay? You can thank me later. But at the end of the movie, the two die like cuddling in bed together. Great story. I mean, not that practical. Okay.
Not reality.
Odds are one person is going to survive the other. And so imagine losing your loved one, right, that you've spent all this time with. Okay. But then also imagine your tax rates going up, right? You're no longer married. You're now single. So you're paying almost a double tax. Also, that Social Security, you're going to lose a Social Security if you're married. Whatever one is the smallest, the surviving spouse will get the biggest one. But so we're going to lose money with Social Security. We're in a higher tax bracket, and you're mourning your loved one. Now, not that a windfall of death benefit is really going to help your mourning, but it is going to make it a little bit easier. It's going to take some stress off. So I think that death benefit, when we do reach there, I think it's unseen, right? That you're going to be very thankful that you had it.
Yeah, absolutely. I couldn't agree more. Let's move on. Number 3. What we're going to be talking about is now the slow start, right? Seen versus unseen. Anthony, share with some stuff, and I'll jump in there.
One thing we like to do is when we talk about infinite banking, we like to explain the good and the bad, right? There's pros and cons to doing everything, and infinite banking is no different. And probably one of the biggest obstacles people have is what we call the slow start. Meaning those first couple of years, you put $1 in premium, you don't have the full access to that $1. It typically takes a few years before it's cash flowing, meaning $1 in and $1 out. Okay. But so there's a slow start with infinite banking, but what a lot of people don't see is that there's a slow start if you don't do infinite banking. Because if you don't do infinite banking, you're buy term and invest the difference, right? Now, those first couple years, the earnings from what you're putting in are probably not going to offset the cost of the term insurance.
No.
So if you put in your whatever you're contributing, and you subtract your term cost, and then you add your investment gains, typically you're still going to be behind for the first couple years.
Mm-hmm. We've got, we did spend some time on this idea, right? We've got a video that we'll make sure that we share in the link where we did a buy term, invest the difference, and did the comparison. And we did dive into that idea a little bit in that video. And so I'll make sure that we share those in there. But then the last thing I'll say with the slow start is, man, just in the last couple years, Anthony, we have created some relationships with some banks in which will help to minimize that slow start for some people. And so if you guys have questions on that, be sure to reach out to us. We won't touch on it in this podcast, but we do have some good opportunities to avoid the slow start. All right, awesome. Let's move on. Cash value, right? We look at that cash value statement. That's what's seen. Anthony, what is unseen?
One of the many things that's unseen is that there's not a lot of moving parts to whole life. I mean, it's pretty
boring.
Pretty boring, right? But
like CPAs, very boring.
But what comes to that boring or just going up a little bit each day is we don't have that volatility, right? We don't have that stress. Like right now, the market is at an all-time high, but it's going to crash, right? It is overvalued. I haven't heard anybody who would say anything different.
Yeah.
Right. But even when this new stimulus package, or the third one or fourth one, right, they did a survey and over half the people are going to take their stimulus money and invest in the stock market. Not because the value or they see value there, they just don't know where to put it.
Yeah.
And they are putting it there. So when that does crash, that's going to create some stress.
Mm-hmm.
Right. And I know a lot of people, a lot of friends that are looking at their statement or their balance every day or once a week.
Yep.
And part of their happiness is determined on if that is going up or down.
Great point there, and I'll jump in here, is because I had a very similar conversation just recently, and I had a gentleman that I was talking to, and young guy, he's buying rental properties, but he was liquidating qualified plans to buy those rental properties. And the conversation we had was, hey, let's fast forward 20, 25 years from now, and let's look at the stress level of kind of where you're going to be at in each road. And when we looked at kind of, or considered the leaving the money in the qualified plans, it was, I don't know if you are personally have a whole bunch of money in qualified plans, or if you know somebody that's in retirement that is solely based upon their income from their investment accounts, they are absolutely glued to the TV. They're glued to the TV because they're looking at the market performance, right? Because everything is based upon interest rates and volatility, and that's their number one concern every single day. And so the stress level is extremely high. When you compare that with having, majority of your wealth either in kind of assets that are cash flowing for you or assets that are sitting in reside with an insurance company, is, man, if you structure this properly and you use the right product with the right insurance company, is all of the risk really lies with the insurance company.
Well
Right?
said.
Yeah. So you're pushing, right, all that risk over onto this huge corporation that has been doing this for over 200 years, that knows how to handle these returns. And man, that is extremely stressful, or less stressful, right? Or peaceful, or provides certainty for you. And so when you look at those two scenarios, it's absolutely night and day.
Cameron, would you explain what a qualified plan is?
Qualified plan is 401ks, IRAs, traditional Roth, anything like that kind of falls under that umbrella.
Okay.
Yep.
Another aspect of the cash value that's unseen is that it's asset protected. Now, each state has some level of asset protection. Some are very good, like Nevada, and I know Texas, and I think Florida is as well. Some are not so good, aka California.
Yeah.
Okay, but even the not so good ones at least have some level of asset protection, which again, as we're talking about stress levels, is knowing that if you do get sued, that a creditor is not going to be able to come after your cash value.
Absolutely. What I always call this the paradox of small business owners, is either you don't have enough cash on hand or you've got too much, right? When you've got too much, you're worried that something's going to happen. You get a lawsuit and somebody's going to get a judgment against it. And so we can go on and on about the creditor protection, but there's probably 15 states that have now jumped on board that all have 100% creditor protection for cash value. But let's move on.
Let's do it.
All right. Awesome. Number 5, I think, is what we're here on. Number 5 is going to be the seen as the 4% rule. Anthony, if you could share with our listeners, what's the 4% rule? And then also, what are some of the unseen characteristics?
Well, the 4% rule is when we have money saved for retirement, typically we're talking in an investment account, is how much can we take out without running out of money? And the problem is there's so much volatility in the market that we need to be very particular on how we take it out. So what the industry has come to solve that problem is called the 4% rule, meaning that you could withdraw 4% of your balance every year to ensure you're not going to run out of money. Now, the problem with that rule, with all the volatility, that number has changed. I mean, some are saying 2 or 3, but let's just say 4. Okay. With a whole life policy, we don't have that volatility, which means we're able to take out a higher withdrawal rate. And that could be between 5 and 6. Okay. So what we're seeing is if we have, say, $1 million in an investment account, cool. We can take out about 40 grand. That's 4%, Cameron. But if we have 100 or $1 million inside a whole life policy, then you could take out between 50 or 60. Okay. But what that also means is to take out 40,000, you could have less in cash value than an investment account and still have the same amount of money.
Great point. What I'm going to add to that right there is that we've also created some content around this as well. The 2 scenarios that Anthony just described, 100% or $1 million of your assets in an investment account, 100% of your assets, $1 million in whole life insurance in cash value. That's right. That's not reality, right? And typically what we're doing, a lot of what we do on the retirement planning side and the income planning side is, hey, we need to potentially have some money in both accounts, potentially. And so what we'll do is we'll allocate that. And the content that we've created talks about, hey, if you've got some money in cash value in a whole life policy, in addition to the investment account, is in those down years, you can now draw the income in those down years from your cash value. And we've put some stuff together that you can actually prolong the investment account over, 50% over the original lifetime at 4% withdrawal rates. But then also you can also double or almost double your retirement income that you take in retirement. So I'll make sure we share the link of that video in our show notes as well.
Yeah, we have one video like that's on YouTube, but then there's a more detailed interview inside our course.
Yeah. Moving on, number 6, our very last one. We've got what's seen is that the policy is going to earn anywhere from 3 to 5% annually. Anthony, what is the unseen about that?
What's unseen is that that's a bottom line number. That's after fees, after taxes. That's what you're going to get. But so many people focus on that 3 to 5. Okay, let's just say 4. But then they're like, I could earn a higher rate of return. But here's the thing. Well, for one, this is an and asset.
Yeah.
So you should be able to earn a higher rate of return than 4. And by running it through the policy, you're going to be able to get both. Okay. But a lot of times people are stuck on that seen number. Well, 4%, that's so low. Well, let's compare it to what you'd have to earn outside of policy. Right? Let's say you have you're in the market and you have a financial planner. He's making some money, and typically there's at least 1 point that he or she's charging. And then I'm not even getting into other fees inside a mutual fund or something. But also, that income is going to be taxable. So if you're in the 30% tax bracket and you pay your financial planner 1%, you're going to have to make 7%. Pay your financial planner, pay the IRS to be left what you have inside your boring 4% whole life policy. And 7% every year with no down years, that
very difficult to do.
Exactly.
We've got, Anthony, that's probably one of my favorite conversations that I have with clients is we use a calculator, Truth Concepts, and I'll use the funding calculator for this. And what it does is it talks about alternate accounts. What would you have to earn in an alternate account just to equal what's happening inside of the policy? And I love that conversation. And in addition to that, an additional resource would be Brian Bloom's books. He's got a series of 3 books that he talks about.
What's it called?
I don't know. I forget what it is. But
it's a sexy title.
Confessions of a CPA.
Yeah.
But a really good book. And actually, we interviewed him. I'll make sure we add that link in the show notes as well. But what Brian did is he actually took into consideration some of the Social Security benefits and the impact that retirement accounts, when you're taking income from your retirement accounts, has on your Social Security benefits and what you would have to earn to kind of equalize that. And in his book, I think he had anywhere from, 10 to maybe 15% is what somebody would have to earn just to equal what's happening inside of that life insurance policy. Really, really good information that takes kind of a holistic point of view when looking at everything. So
yeah,
I'll make sure I add that.
Sorry, Cameron.
That's all right.
So, I'm not really sorry, but
Yeah, I know.
some of that unseen, right, is having that tax-free income.
Mm-hmm.
Okay, a lot of things are going to count against you when you're in retirement. Like Cameron had mentioned, Social Security. The more taxable income you have, the more that's going to be taxed. But also, and part of the Obama care, what's also going to be affected on your taxable income is going to be your Medicare premiums. And they can actually be 4 times higher if you have more taxable income.
Crazy. Anthony, so that wraps this up. We've kind of come to the end. We talked about the seen versus the unseen on 6 different characteristics of the policy. The way that I would summarize this is the reason I guess that I like this conversation is because most people just focus on one thing when they're comparing it. And I think Brian says this in his book. I'll give him credit. But I think today, and as you start kind of new financial planning, a new perspective, is you have to have more considerations than just rate of return when you're trying to compare strategies. And so I think this is kind of what helped us with the seen versus unseen topic. What do you think?
I totally agree. Well said.
Thanks. Awesome. Hope you guys enjoyed this episode. I'll make sure to we get those links in the show notes so you guys can check out all the additional resources.
Make it a fantastic day.
Take care.